Alright, for this video we're going to go over a 2022 Form 1120S tutorial. So 1120S is an S Corporation tax return, and the fact pattern we're going to be working with is a lawn care and landscaping business. Now this is the second video for this same fact pattern. If you watched the previous video, I'll put a link to that below, but we covered how to prepare a 1065 partnership return for a lawn care business. So now we've taken effectively the same kind of fact pattern, but we've modified it slightly to where the company is taxed as an S Corp. And so how does that change all of the relevant reporting? So I'm going to quickly go through everything we have in front of us, and then I'll come back to the slides. So in the slides, I've got a summary of all the issues that we're going to cover, all the forms, schedules, and statements, things we'll talk about. And then obviously we do have the tax return itself, so we'll go through the full 1120S. I'll talk about all of the relevant pieces and what you need to be completing. And then of course we do have a set of financial statements for the company. So a profit and loss statement, balance sheet for the company. We do have a book tax reconciliation that we'll go through to highlight some of the different separately stated items and the book tax adjustments. And then just a very simple shareholder cap table or capitalization table that shows the amount of common stock and APIC issued during the year, and then the allocation of net loss to the company. Okay? All right, so let's go back to the slides, and then we'll start working through the fact pattern and then get into the return itself. All right, so on the second slide here, we've got the fact pattern we're going to go through. So I'll run through all of the elements first, and then we'll start looking at the financials and the tax return. So here's our fact pattern. So we've got John Smith, Jane Doe. They're friends, and they decide to partner up and open this landscaping business. So they're each going to own 50% of the company, but only John's going to be actively involved in the business. Jane will kind of consult with John, go to board meetings, things like that. They'll have those meetings. But she's not going to be actively involved in the business, right? John's really going to do all of it. So Jane is really kind of more of a passive investor. And the reason why that's relevant is because John's going to be the only one that's on the payroll, right? And so John's only going to be paid $5,000 for the year. And the reason why they set that quite low is because the company's brand new. They're not super profitable yet. And so John is going to basically get paid very little so they can afford to pay their other employees and cover all those other costs. Now, John and Jane Doe each contribute $10,000 in cash to the company, so that's the startup capital, and there were no distributions during the year. Now, the corporation during the year purchased 2 mowers, a truck, and a trailer. The mowers and the truck were financed. And the owners had to sign a personal guarantee in order to get the financing for them. That's okay. We'll talk about shareholder debt basis and stock basis, and we'll touch on why that is significant. The company's going to be eligible to claim 100% bonus on all the equipment, so that's good. Next element here, John opened a brokerage account under the company name and tax ID number. And so the brokerage account, they have just cash in there, and they did purchase some stocks that are paying out dividends. And so they received some interest income and some dividend income, and those are going to be separately stated K-1 items. And so we'll look at that in more detail as well. Now, John also decided during the year that he was going to hire a part-time admin person through Florida's Work Opportunity Tax Credit Program. So the Work Opportunity Program basically says if you hire an individual through this program that qualifies, you can get a federal tax credit for a percentage of the wages you pay them during the year. So this individual worked 450 hours during the year, was paid $7,200 in gross wages, and so we'll see how all of that is reported on the 5884. Now the company also obviously spends a lot of money on fuel, so they track their fuel costs and the number of gallons purchased during the year for both the lawnmowers and the truck. Now the lawnmowers, the reason this is significant is because the fuel purchase had the federal taxes in it, and because they use the fuel for off-highway use, they can actually get a federal tax credit on the fuel used. So they bought 4,206 gallons of non-dyed fuel during the year for use with the mowers. And so they're going to be able to claim a federal fuel tax credit on those amounts and file the Form 4136. Now, the credit is going to be refunded at the company level. What does that mean? Well, if you watch the 1065 video, the credit was passed on to the partners, and then they have to claim it on their personal returns. With an S-Corp return, the company itself is going to claim the credit and get the refund directly. And so we'll see how that different reporting works. And then lastly, the company purchased small tools and equipment. It deducted those costs currently rather than capitalizing them and depreciating them. And so they are going to file an election for the de minimis safe harbor. Okay. All right. So let's look at the financial statements, go through these briefly, and then again, we'll jump back to the tax return. So on the left-hand side here, we've got a profit and loss. So the revenue, gross revenues for the company, all of those direct costs that are being categorized as cost of goods sold, and then the various expenses for the business. So the administrative staff persons, wages, officer wages, insurance, repairs and maintenance expense, so on and so forth. Notice here the depreciation expense, $73,500. That is for the full cost of all the fixed asset purchases, and that's because we are going to claim 100% bonus depreciation. Now, it's certainly possible and likely that you might have different depreciation standards for book purposes. In this case, they just wanted their depreciation to match what they had on their tax return. So that's why for book, they have the 100% bonus depreciation being recorded. And that's fine. If you don't do that, let's say you had US GAAP methodology for depreciation. When you claim bonus depreciation on the return, you would see a book tax adjustment for the variance between the tax depreciation claimed on the return and the book depreciation on your internal financials. But in our case, they're going to match, so it's going to make it a little easier for us. All right, so let's have a look at, and then these items down here. So remember, similar to partnerships, S corporations have certain things that have to be separately stated. So in other words, they can't be included in page 1. So on page 1, we report the ordinary trade or business income and expense of the company. So for separately stated items such as interest, dividends, they cannot be included in page 1. They have to be separately stated on Schedule K. So when we look at Schedule K here, line 1, ordinary business income or loss up here, this is the total, the net amount flowing through from page 1. Separately stated items are listed here, lines 2 through 16F. So we look at, for example, interest income, line 4, there was $10 in interest. That has to be separately stated on the K1. It can't be included in line 1. All right, so we'll come back to this in a little bit. All right, so that's why we have them separately stated down here, the dividends from the brokerage account, the interest income, and then I have just a note here on the source of the regulation for why we have to do that. So if you look at the Treasury Reg 1.1366-1, A2, we see the guidance that these have to be separately stated. All right, so if we start with the return, obviously best place to start is at the top, right? Input all the identifying information on the company. So we have our fake Lawncare business, street address, EIN is the tax ID number, so that goes in box D, and then the date the company was incorporated or formed. Right, so in our case, the company was established Jan 18th, 2022, and the S election, so we filed a Form 2553 S election effective the same date. So these two dates match. They don't always have to, right? You could have a company that was set up and was a C corporation or a partnership or a disregarded entity for a number of years, and then it filed an S corporation election later on. Then you would have a variance in the dates. All right. Now at the top here, notice where it says for calendar year 2022 or tax year beginning. We have entered the start date as January 18th, 2022 because the company didn't exist for those first 17 days of the year. So it wouldn't be appropriate to say it was in existence for a full calendar year. So that's why we've entered a short period return date. Now the second place to start, in my opinion, that's good, is Schedule B. So Schedule B has a lot of yes or no questions, more informational stuff on the company. And I like to go here next because it helps us kind of determine what additional forms or schedules we may need to include, or what things we can just omit, right? What don't we have to be bothered doing? So at the top here, right, accounting method, we're using the accrual method. We are in the lawn care and landscaping business. So all these other yes or no questions down here, you'll notice that most of these are all no for us, right? So no, for example, no, we don't have any restricted stock that's outstanding. No, we don't have to file any 8918s for material advisor disclosures, and so on and so forth. The one item we did answer yes to down here on line 11, right? So the corporation's total receipts are under 250 and our assets are under 250. Now, if you answer yes to this, notice here it says that we don't have to do schedules L and M1. We're going to still do those as a matter of kind of practice and habit. I always like to do a full balance sheet, an M1, and a capital account reconciliation too, simply because I just think it provides a little more information and it's more accurate for the user of the return. So it's easier to know that the return is accurate when it kind of reconciles very closely with the financial statements we have. So we will be doing those schedules even though we don't necessarily have to. Questions 14A and B, right, 1099. So we did have to issue some 1099s to our independent contractors. So we clicked yes that we had to do these, and then again we clicked yes on 14B that we did file them. Now, Schedule K, shareholders pro rata items, we'll come back to this after we look at page 1. But if I go back to page 1 here, remember, this is where we're reporting the ordinary income. So it says caution, include only trade or business income and expenses on lines 1A through 21. So again, what they're highlighting there is only have trade or business items here. Any separately stated K1 items need to be separately stated on the K1. We cannot aggregate them within these lines 1C through 21. All right. So if we look at the financial statements, you can see here on the left-hand side, we have the book profit and loss statement for the company, all the items. But before we start entering this stuff into page 1 of the 1120S, we want to make sure that we are only including, again, those ordinary trade or business items. So in our reconciliation here, what I've done is on the left-hand side, we have the book income and expense just as it is on the financial statements for the company. So these are the unadjusted numbers. Page 1 of Form 1120S, what we're including here are the amounts that should be included on page 1, and we're omitting the separately stated items and any other adjustments, in accordance with the instructions. So what you'll notice here that is pretty much the same as most of these line items. Here's the items that have changed, right? So notice the admin staff wages, $25,500. The amount we're reporting on page 1 is $22,620, so the variance is $2,880. This item, and we'll come back to it, is the work opportunity tax credit. So the work opportunity tax credit, you cannot take a tax deduction and a credit for the same amount. So if we compute a work opportunity tax credit, we have to reduce our deductible expense by the amount of credit. Now, that doesn't mean we're missing out. This is still okay because although we might not get to deduct this $2,800, a tax credit is a dollar for dollar offset against our tax. So this credit is more beneficial. So again, we'll come back to that when we look at the 5884 later. Down here, no other book tax adjustments for any of these items, but you do see here we are not including the separately stated items. So dividends from the brokerage account and interest income, I'm not including these on page 1. These will be separately reported on the 1120S. So if we enter everything as it is per the financial statements and the reconciliation, our bottom of the line, ordinary income or loss, the loss will be $54,030. And so that's what we see on the tax return, right? Line 21, we have $54,030. So we've got our gross receipts up here. Our cost of goods sold are entered on the 1125A. And then we separately state the wages for the officers, right? So there's John's $5,000 salary. All the repairs and maintenance expenses, taxes and licenses, interest, right? All of that looks fine. And then also note again, the wages and salaries to the employees, $22,620. So that's been adjusted after the reduction for the non-deductible work opportunity tax credit. So when everything is said and done, again, at the bottom of the line there, we got minus $54,030. That amount flows through to Schedule K, line 1. So there's the $54,030. That's the very first item on Schedule K, so that's what's ultimately going to be allocated across to the shareholders. Now, as far as those separately stated items, right? So interest income, right? We got the interest income up there on line 4. We've got the dividends, $40 in ordinary dividends. According to our brokerage statement, all of it was qualified, right? So of the 40 is qualified, so that's fine. And then the credit section, here we can see our work opportunity tax credit, and then an offsetting portion for the non-deductible expense piece. So if I jump through to the 5884, all right, so bear with me one moment. Let me find it. Okay, here we go. So again, the work opportunity tax credit gives you credit for a percentage of the amount of wages paid to employees under these programs. So in our case, the administrative person was paid a total of $7,200 in wages during the year, and they worked 450 hours. So they fall within 1B as qualified first-year wages of employees who worked for at least 400 hours for us during the year. So you've got the $7,200 there, a 40% credit, and $2,880 is our tax credit. All right, so the $2,880, that then flows through to Schedule K, as we saw before. So if I look at Schedule K, I have Schedule K here, line 13G, other credits, and then we attach a supplemental statement that just indicates this is a work opportunity tax credit. And the reason why we have to report on 13G and attach a statement is because it doesn't fall squarely within one of these, right? If we had low-income housing credits, those would be reported here. But because we don't have a line item, we have to just put it in other credits and then attach a statement. Now, I think the next good place to go from here is probably the balance sheet. So when we look at the balance sheet, it is balance sheet per books, right? So the balance sheet per book should reconcile with your books, right? That's pretty obvious. Now, what's going to be important to remember, and depreciation is a big one. It's probably the most common book-to-tax adjustment that you'll see on the balance sheets. If you look at your buildings and other depreciable assets and the amount of accumulated depreciation doesn't reconcile with your books, for tax purposes, that's okay, right? You would use what you have on your books, and then you would have a book tax adjustment that would ultimately come down here on Schedule M1 that would reconcile the difference between book and federal tax purposes for depreciation. Again, remember, in our case, we're just making a match to try to make our lives a little easier. And because John and Jane don't have to prepare U.S. GAAP financial statements, they just don't care, right? So they're just going to make their book depreciation match what they have for tax purposes. So the balance sheet, relatively straightforward, right? So if we look at the balance sheet here, we have the cash accounts, separate entries for the ending value of the brokerage account, a security deposit that was posted. In the fixed assets section, the $73,500, that's all the cost basis for the purchases, right? So they bought 2 mowers. Those are commercial grade mowers. They bought an F-250 truck, a trailer to haul the mowers around, and then they're going to depreciate the entire amount under the bonus depreciation rules. In the liabilities and equity section, accounts payable, some payroll liabilities, credit card balance, and we can see here the note balances, right? So they owe a decent amount, right, on the F-250. Most of it was financed, and then the same thing with the tractors, right? So the the lawnmowers, right? So the 2 lawnmowers, most of which was financed, they only put a little bit of cash down, so they still owe $22,635 at the end of the year. In the equity section, so a little different than what we see with a partnership balance sheet, right? So we have capital stock. That's the amount of units issued in the company. So if it's an LLC S Corp, it's LLC units. at basically whatever the par value of the issuance amount is, or in this case, it's a corporation. So what is the par value per the corporate charter? And in our case, it was issued and authorized to grant 1,000 shares at a $1 par value. So that's why we have 1,000 US dollars. APIC, or additional paid-in capital, is the amount of cash or property that the shareholder contributes in exchange for the stock in excess of par. So remember, this total is 20,000, and that's because John and Jane each put in 10,000 apiece. But because the par value is only 1,000, the excess, the 19K, is all the APIC. So that's the additional paid-in capital amounts. All right. So those amounts are just flowed through or reported here on Schedule L. Right. So notice beginning of the year numbers are 0 because we didn't exist last year. So when you have a new company, you're not going to have beginning of the year numbers. So we've got our cash balance here at the top. So 16,441. The security deposit in the brokerage account. There's our depreciable assets, right? So the mowers and the truck and the trailer all written off. We'll look at the 4562 next for the depreciation. Accounts payable, so other liabilities in there. There's the mortgages, notes, bonds payable. So notes payable in one more a year, right? So more of a long-term debt, 61,835. And then we have our common stock and our APIC amounts. So let's look next at the depreciation. So depreciation expense. Let me go to the depreciation schedule. So here's our depreciation listing. Now, this is not a required form with a tax return, so you don't send this to the IRS, but you should have one prepared with your return and at least kept internally so you can track the assets and their useful lives, the depreciable basis, all of that good stuff. So we've got the two mowers, the truck, and the trailer all added there. Now, the cost basis listed here, again, this is going to be 100% used for business because that is the case, right? All of these are just business use assets. So we're going to depreciate all of these and write them all off completely. So the 4562 really split up into kind of two main sections that I think are important, at least in this context. So page 1, we have part 1 is 179 expense. So if you didn't use bonus, you might be able to write it all off under 179. In part 2, we have the bonus depreciation. They call it special depreciation allowance for qualified property other than listed property, right? So why is this important? Listed property are things like automobiles, right? And so when we take bonus depreciation on listed property, it's separately stated from here. So this is just the mowers and the trailer, right? We can't include bonus depreciation for listed property such as the F-250 truck. So when we have the truck, we have to separately report those items in part 5, and then ultimately it flows up here to part 1 and we get our total. But if we look at part 5, so this is the listed property section. We have on line 26 here, property used more than 50% in a qualified business use. And that's us, right? So John and Jane don't use this truck for anything but for work because it's just always hooked up to that trailer to move the mowers around. So we have the F-250, day, place, and service, 100% business use. So the cost basis, $44,850. The full amount is being depreciated here on line 25. All right. Now, what else needs to be done? Because this is listed property, right, we have to answer 24A and B. So we have evidence to support the business use claimed, yes, and the evidence is written, also yes. In section B, information on use of vehicles. So because our owners do have access to this and they work with the crews, anytime you have a more than 5% owner or related person using the vehicle, you have to disclose some additional information here on the vehicle use. So the key pieces to disclose are total miles driven for business use, total commuting miles, total personal use miles, and then also answer these yes or no questions. Was this vehicle available for personal use off-duty hours? And the answer is no, right? The owners are not using this. They're not allowed to use it, and they both agreed upon that. The vehicle was used primarily by a more than 5% owner, and then another vehicle is available for personal use. So John and Jane do have their own cars. All right. So once all of that expense is totaled up here on line 22, that's the amount that's flowing through to page 1, and it's being deducted on the return as depreciation expense. So we've got line 14 here, 73,500, and so that's what arrives in our line 1 net ordinary loss of 54,030. Okay, so now let's next talk about this federal tax paid on fuels, this credit. So you notice here on page 1, there is a separate line item for it. So on 23C, we have credit for federal taxes paid on fuels, attached of 4136. So if I jump to the 4136, okay, so this form, as it says here at the top, it's a credit for federal taxes paid on fuels. And so this is designed to kind of give you a reimbursement of the tax that was imposed on the fuel purchases when you were buying the gallons throughout the year. Right. So in our case, we have non-taxable use of gasoline. It's off-highway business use. The reimbursement rate for the 2022 year is 0.183 cents per gallon. And so our total gallons provided were 4,206 during the year. So we're going to get a credit of $770. Now, what's really important here to remember, there's a couple of things. So first, notice with the S-Corp return, it is actually being refunded at the company level. Okay, so $770 check is going to come our way when this return is filed and completed. In contrast, when we had a partnership return, 1065s, the 4136 wasn't even filed with the return. We had to report the information separately on a K-1, the partners file, and claim the credit that way. Now, the other piece to remember here is when we get this credit back, we have to record it as income in the year we receive the credit, right? And so this is, again, it's similar to the work opportunity tax credit issue where you can't kind of double dip on the taxes and the credits. So if you claim this credit and we get a check back, that's nice, but we're going to have to include it in income next year because we took a full deduction for all the fuel costs in our cost of goods sold. So in our cost of goods sold on 1125I, we deducted the full amount of the fuel. So that means when we claim the credit back, we have to record it as income. All right, so let me touch on schedules M1 and M2 really quickly here. Okay, so M1 and M2, remember, we didn't have to file these because our income and assets are under 250. But again, I think it's really important to have this information because it provides you, much more information on the tax aspects of the company. So the M1 is a reconciliation of our loss per books to the loss per return. So our net income or loss per books, 56,860. This should reconcile with the financial statements that we have for the company. So our net income or loss per books down here is 56,860. So that number looks good. That agrees with what we have on the tax return. Now lines 2 through 7 here are where we have any kind of book tax adjustments. Now the only one you notice here is the reduction in the expense for the work opportunity credit amount. So on line 3, it has expenses that we recorded on books that we cannot deduct on the return. Right? So if we remember looking back at our book tax reconciliation, the amount of expense that we had on our books, $25,500, we are only allowed to deduct $22,620 on the return because we are claiming a credit for the work opportunity tax credit. So that's why we see a non-deductible item here for the same amount. All right. Now, M2 is a roll forward of effectively the retained earnings of the company, but it could include items in these other columns. If, for example, you were previously a C Corp and then made an S Corp election, you might have some undistributed taxable income that was previously taxed. But in our case, we've got a fresh S Corporation here. It was never previously a C Corp. Nor do we have any unique adjustments that we would see in column D, for example. So one we saw a lot of recently is PPP loan forgiveness, right? So if you have some of those debts forgiven and they were exempt from taxation, you would see adjustments there for those items. But in our case, again, we have relatively simple fact pattern, so it doesn't apply. So we're just working with column A, our AAA account or accumulated adjustments account. So the additions to income are the investment income. So that's the dividends and interest. So those are positive amounts. We have our loss, our 54,030. That's our taxable loss from page 1. We also have to reduce our AAA account by any non-deductible items. So there's the 2880. And then our net balance, 56,860, is kind of more or less our retained earnings for the year. And so that's what we see up here under retained earnings line, 24, negative $56,860. All right. Okay, so now that those items are completed, let's start looking at Schedule K itself. So Schedule K1, not Schedule K. All right, let me get through. Okay, here we go. So Schedule K1. Every shareholder gets one of these, right? And every shareholder should get one, regardless of how small of an ownership percentage they might have, right? So even if you are only like a 0.5% owner, you would get a 0.5% allocation of all the tax items. In our case, we have John and Jane, the only two owners. They each own 50%. So the Schedule K, corporate information goes here in Part 1. So company's EIN, company name and address, and the total number of shares that were issued. So in John's case, he's got 500 shares. Jane's got the other 500, so 1,000 total shares. Part 2 contains more information on the shareholder, so John Smith, and his allocation is going to be 50% of all these items. Now, when we look at Part 3, these are the items flowing through from Schedule K on the 1120S. So if we go back to Schedule K, think of it as this is a listing of all the totals that have to be allocated across the shareholders depending on their ownership percentage, right? So 54,030 is the total amount of net ordinary loss, and then that is allocated to John and Jane under their respective ownership percentages. So if I go back to John's K1, his line 1 amount, this is 50% of the allocation from line 1 ordinary loss, right? And then the same principle applies for all the other line items. So he gets half of the interest, half of the dividend income. 13J, this is the work opportunity tax credit. So 13J, $1,440 is going to be the amount of credit that John is eligible to claim on his tax return. 16C, items affecting basis. So those are non-deductible items being allocated. Those are also shareholder distributions if there were any. And then line 17 contains other information that is included normally in these supplemental schedules. So when we look at the supplemental schedules down here, we can see our line 16 amount, other non-deductible expenses, and they're letting us know that this is attributed to the work opportunity tax credit. So John knows, okay, well that's why I have a non-deductible item, because I have a line 13J amount for work opportunity tax credit. All right. QBI information. So this is really important for taxpayers and with pass-through entities. So QBI, or Section 199 Cap A, provides a tax deduction on the allocation of pass-through income or trade or business income coming through from a partnership or an S Corp. You can also get it if you're a sole proprietor, right? You're just filling out a Schedule C. But in this case, we have an 1120S with a K1. And so we do have a qualified business. So this is a qualified business under Section 199A. And so John can use this information to determine whether or not he gets a QBI deduction on his personal return. So the amounts that are reported are the line 1 ordinary income or loss, and then these other items of income or loss if they applied. In our case, they don't. And then an allocation of the W-2 wages that were paid during the year, and then an allocation of the unadjusted basis of property, right? So the fixed assets on the balance sheet, effectively, that's John's 1/2 allocation of those assets, and those amounts are relevant because you need to know that in order to figure out any kind of phase outs that might apply. All right, so the next item here is the shareholder basis worksheet. Now, this is also, again, not a required schedule with the 1120S, but I highly recommend doing them. What is important now is, as the note is highlighting up here, 7203 was a new S Corporation basis form, and it has to be included with the shareholders tax return. So this is kind of like a makeshift basis worksheet, but 7203 would have to be included with John's personal return. Obviously, we're not going to cover that in this video because we're just doing the 1120S return. But when we talk about stock and debt basis, so a shareholder in an S corporation, their basis is comprised of stock or debt basis, right? Now, stock basis is the cash or property that they put into the company, and then it's adjusted up or down for any allocations of income or loss. So John put in $10,000 of capital during the year when he purchased the stock, so that's an increase to his basis. And then he also has increases for the allocation of portfolio income, so the interest and dividends. And then his basis is reduced by non-deductible expenses and an allocation of ordinary loss during the year. Now notice what's happening here. The loss is being capped. He's not getting a full deduction for all the loss, right? And so why is that? When we look at the carryover down here, the total amount of losses and deductions that he got allocated during the year were $28,455. However, his basis was only $10,000 plus the $25,000 in positive income allocated. So what that means is that he has got losses, deductions that are being allocated to him in excess of his basis. Now, when he does his personal return, effectively he's not going to be able to deduct all of these losses being reported here on line 1. Right, the $27,000, that is all the loss allocated to him, but because he doesn't have enough basis to absorb all of that, he has a carryover. And that's what this worksheet is highlighting down here, is that there is a carryover amount down here for disallowed losses, right? And so that's what he's going to have to do. He's going to have an $18,430 carryover amount. That's going to be losses carried over to the subsequent year. And it's at that point he can figure out, well, if I have positive income next year, maybe I can start absorbing some of that loss. But at least for this year, he's going to have a ceiling, right? He's not going to be able to write off all of those losses because of the debt limitation, or the basis limitation, rather. Now, the reason why debt is interesting in an S-corp context, remember when we talked about partnership basis for a partnership. So if we look at the balance sheet here, when you're a partner in a partnership, so Form 1065 filings, any kind of debts on the company balance sheet can be allocated to you and increase your basis, right? When we talk about partner's basis under 704D, an allocation of all recourse, non-recourse debt, qualified recourse financing, it increases your basis in the partnership. And so with a partnership being allocated losses, you might be able to deduct all of those losses. In an S-corp context, you don't get that. Right, so in an S-corp context, the debt basis down here, there isn't any increase for his share of liabilities. He also can't, because he had to sign a personal guarantee to get the financing for the mowers and the truck, he can't impute those debts to himself either, right, because he kind of takes responsibility for it. That's the general rule. Now, there have been some cases and some really unique exceptions where if you personally took on a debt first and then transferred it to the company, then it might apply. But in this case, if you have S corporation debt, it does not increase your debt basis. You just have your stock basis up here. All right. Okay. So last thing, actually second to last thing, we'll cover the K3 exemption and then the de minimis safe harbor. So Schedule K-1 supplemental information. Recall in the fact pattern that what we said was they were exempt from filing K2 and K3. So if you do that, if you are eligible for the exemption and you don't want to do K2 and K3, you have to include this statement with the K1s provided to the shareholders. Right, so the corporation has met the criteria for 2022, exempting it from filing K3. Right, a corporation had no or limited foreign activity, and each shareholder is a U.S. citizen, resident alien, or domestic trust. Now, you're off the hook for filing this, but the reason why you're providing this to the shareholders is they have the option to request the information. Right? So if you provide this to John and John says, actually, I need the information on K2 and K3, please provide it to me, then you would have to do it. All right, but in our case, we're filing this notification to be exempt. All right, so now the last thing is the tangible property regs, so the de minimis safe harbor election. So recall on the financial statements, the S Corp return, they have some purchases for computer equipment, tools and equipment. And what we have done is we've decided to just expense these currently rather than bother with filing, with reporting them as assets and depreciating them. Right now, if you do that and these assets are small enough, they fall under the exclusions. You can write them off like regular trade or business expenses. That's fine, but you have to attach the de minimis safe harbor election, and so that's what we've done here. We've made this election saying that we are making the de minimis safe harbor election under 263A-1F, and so then you're good to go, right? You just have to make the election, and that'll keep the IRS happy. All right, so. That covers it for this video. I hope this was helpful. If you have any questions, leave me a comment below, and I look forward to seeing you again on the next video. Thank you.